All right, good afternoon, everybody. Thank you for joining us for today's webinar. My name is Heath Birch, and I'm the Director of Wealth Management here at CommunityAmerica. As a team of roughly 30, our job within the credit union is to deliver wealth management and financial services to our members. And as many of you could probably imagine, over the course of just the last couple of months, the number one question we're getting is the potential impact of the election on a family's savings and finances. So this is an attempt to address some of those questions. I want to be really clear on the front end that the intent here is to be nonpartisan. There's not a bias or an angle here. Hopefully you won't pick up on any political leanings. We're going to try to base this in historical facts and talk a little bit about what's happened in past elections and how this one might be the same or might be different. And so, as we've been asked these questions, the intent here is to give you some balanced information. As we will relay some facts, I think sometimes you may perceive that as a political statement, but it really won't be. It'll be talking about past elections and just what we've seen and what we think may happen from here. So we recognize that elections can be contentious, and this one certainly is. But the approach here is to provide information to let families do with it what they may inside of their own personal financial situation. So I do want to provide a little bit of a historical baseline before I bring our guest in. Because there are questions that we tend to get that, oftentimes we're being asked by multiple people, and they center around, past election cycles and what we can glean from those and maybe what we should take from them as we look ahead to this year. And certainly which party sits as the incumbent has mattered in past elections. Market movement during the year of the election has historically been exaggerated when we have a Republican incumbent. And that means both directions. It means when things go well that year, it seems to accelerate with a Republican in the seat, and the reverse. When the market pulls back, it seems to be accelerated. But interestingly enough, in the following year, if you have a Republican incumbent and you then have a Democrat that takes office, the market tends to perform better. And so you can see in whether you happen to be on either side of the fence that there's historical precedent both in the year of the election, the year following the election, that we could be in for some volatility based on the fact that we have a Republican in office now, and we have, at least today, polls indicating a greater probability for a Biden win. But as you kind of look at the direction of the market economy as a indicator of what's going to happen, if you go back over the course of the last 70 years, we've had 6 different times in which we've had somebody in office and we've experienced a 20% drop, whether it be a 20% market drop, which we consider a bear market, or some form of recession. And we're dealing with that now, which plays into this election. But the question becomes that, this year was unique to many years in the past because of COVID, and how are we supposed to interpret that? So there's differences in the candidates that we don't necessarily need to unpack fully, but our focus here would be on the differences, the market's perceived differences between the two candidates. At a very high level, you could see that, tax consistency might continue with Trump, with less change there, but maybe a more, tough stance, we'll call it, on China and foreign policy. Whereas with Biden, you could expect some tax increases, albeit ones where he's focused on those making over $400,000 and on corporations, and then maybe a more predictable trade policy. So as we kind of look at those things, ultimately, I think what I would say to level this out is that historically, it hasn't mattered a great deal whether it's a Republican or a Democrat. Market trend is up, and volatility can find us on the back of an election because the market doesn't like uncertainty. So that's what we're going to try to unpack today, is just what we think could occur based on a few different outcomes. And luckily to do that, we've got the help of Tim Holland with Brinker Capital with us today. So just to give you a little background on Tim, I'll tell you, we're lucky to have him from the perspective that he's someone with 20 years of investment experience, but probably more importantly, it's what he does in his day-to-day in the investment world. So he's the Senior VP and Global Investment Strategist with Brinker, which essentially means he's a part of the team that's developing and kind of delivering the economic and market outlook for their entire firm. And Tim is a guy you'll see all over. If you're paying attention, you could have found him on CNBC's, on Bloomberg, Wall Street Journal, Financial Times. So I think it's fortunate that we get to invite Tim to join us and our members. So with that being said, Tim, are you ready to roll with some of this?
Yeah, I think so. And Heath, I haven't seen you in a long time. Congratulations on that awesome Super Bowl win, right? I know it's been a while, but I assume you guys are still basking in the glow of that. And for what it's worth, my son Spencer is huge into fantasy football, and Patrick Mahomes is always at the top of his draft list. So anyway,
Cool,
I'm ready to go, and it's great to see, and I wish we could be together in person, but hopefully that'll happen soon as well.
Yeah, well, I appreciate it. There's when I was kind of thinking through different ways to go with this, there are so many things that we can talk about. And so what you want to try to do, or at least what I've wanted to do, is try to in some way make this actionable for our members as they kind of think about their own situation. So I'll try to stay linear, but this could go a few different directions. And if it does, we'll just kind of go down the direction that we find ourselves in. So one thing I think we could probably both agree on is that as investors, a lot of us can kind of overblow our current feelings, right? We can kind of exaggerate our feelings, then get a hold of us and emotion takes over. And it can, sometimes it lasts for a little while, sometimes it can last a little bit longer, right? So this can be even more true potentially after an election. One of the things that you can see is a reversal of market trend when the challenger takes office. And I was looking at 538 yesterday and their predictions or their polling, and we know that the polls can be wrong, right? But as we sit today, they've got Biden at 87%. So I think it's something that we should consider. If we end up with a Biden win and we get that turnover, do we assume there's some reversal of recent direction? And how's that complicated by the fact this year's been so up and down to begin with?
Yeah, right. In a normal election year, that'd be a pretty good assumption to make based on history, to your point. Earlier, the market doesn't like uncertainty. You get a change instead of another 4 years for the incumbent party and an idea of where policy is headed. You know, you're sort of changing. You're changing out one president for another, but then you have this pandemic that we're all managing through. I think you know, if you get a Biden presidency and as opposed to another 4 years of Donald Trump, I think then you have to look at the other end of Pennsylvania Avenue, right? And that's the other big part of this story, right? You know, the presidential, the contest for the presidency soaks up most of the oxygen in the room, but boy, the Senate's a big, big deal too, because to affect any sort of major legislative change, if you're President Biden, you need Mitch McConnell no longer to be running the Senate. You need Chuck Schumer, and you obviously want Nancy Pelosi to continue to be the speaker. So I think if Joe Biden wins, you look immediately to the other end of Pennsylvania Avenue. If you do get a Democratic a blue wave, or at least the Democrats take both ends of Pennsylvania Avenue, then I think you're potentially in for some legislative initiatives around taxes that you've already talked about. Then I think, you know, what's the makeup of the Senate? How progressive is that Democratic majority, or is how middle of the road is that Democratic majority? If you think about sort of the middle of the country and the upper Midwest and where this race is going to be run and won for the presidency, you know, the Democrats have got to flip some seats in some more moderate conservative parts of the country. So, you know, I'm of the mind that even if the Democrats take both ends of Pennsylvania Avenue, outside of maybe some changes to tax policy, you're probably not going to see a big shift in policy. I just don't see it. You know, they've talked about going after big tech and some other things. At a high level, what you probably get more than anything else out of a Democratic blue wave at both ends of Pennsylvania Avenue is a big stimulus package.
Right.
And I honestly think, even though I know a lot of folks are focused on tax policy and whether or not taxes are going to go up on corporations and capital, I'm of the mind, and this is my opinion, I may be completely off base, that if interest rates are low and the bond market's behaving itself, and the government can continue to spend and borrow the way it has been, I think you probably get the big stimulus package out of a Democratic wave election. But you don't see taxes necessarily going up, at least not in 2021. You know, we're 8-10 months into an economic recovery. And if the bond market and yields are behaving themselves, sorry, my dog's barking. My wife Meredith's going to grab him. Hey,
That's
Winston.
the beauty of these.
He's a great dog. Thanks, hon. You know, do taxes really go up in that environment? And then the other thing that's, I think, worth paying attention to is, and again, that change in control can be a little unsettling. You know, if the economy continues to reopen, you get some good news on the vaccine, on the vaccine or treatment front. I mean, that's just going to supercharge the market, in my opinion, and that would overwhelm any concerns, I think, around political uncertainty in DC, policy uncertainty. And then finally, the other thing that's interesting, we were running these numbers today, when the market's up for into the election, when the S&P is trending higher, and it's been trending higher, typically the next 3 months after election day have been positive over 80% of the time, with a total return of about 3%. So you've got pretty good momentum going into the election.
Right.
You're probably going to get a big stimulus package out of a Democratic wave. And again, I don't think taxes are going to be all that front and center, as long as the government can continue to borrow and spend, as opposed to having to sort of pay for the spending. So I think a lot of the conditions today would overwhelm that classic kind of, you know, the market goes the other way when you have a change in control, at least as it concerns the White House. Yeah,
it makes perfect sense. You see a lot now, even those that would assume that if Trump maintains the presidency, that there could be, there could be stimulus coming out of both sides, right?
Yeah.
And so you're onto something interesting there, that the assumption is always that there's these divergent views, and as a result of that, immediately something's going to change. And there's a lot of reasons why it may not be any different in the short term. Even though we'll get back to it later, because I think it's interesting, but your comment about the potential blue wave, I think there's some things to unpack there too, just in that sometimes markets can like a logjam because they assume they can predict a little bit more what's coming. Change won't come so quick, and I don't know that necessarily holds this year. So we can maybe swing back into that one. To build on that first question though, one of the things that I think I've just kind of been thinking through is that oftentimes as investors, we are, we're casting a vote based on our pocketbook, right? If our view of the market is positive, if our view of the economy more broadly is positive, we tend to be more inclined to stay the course, right? And so this year to me is interesting though, because you go into February and largely people perceive the economy as doing pretty well. Yeah. And then we hit a wall, right? And at least at that time, there were no politics involved in the fact that COVID was something new. And for the first couple of months, the market wasn't worried about the response to it. They're trying to get their head around just what is this and what's this look like. So if, markets now are kind of broadly positive for the year, but embedded in that year, we've had the fastest bear market in history. And then we had one of the fastest bull market recoveries, right? Yeah. So this year just feels different. So is this again a situation where we have to throw out some of that historical context because of what's occurred? I'm going to stick with, I'm going to go with no, right? Yeah. I'm just going to assume that past is prologue because that's kind of what we have to go on. Mm-hmm. And so that would mean maybe some volatility after the election if Donald Trump loses and Joe Biden gets in. But I think the other end of Pennsylvania Avenue is going to have a big impact on that. And if it is, again, a Democratic wave, what kind of Democrats run and take the Senate, right? Yeah. Because that's going to have a huge impact, I think, on the tone and tenor of legislation and fiscal policy. But the reason I want to go with history is, even in light of everything we've been through that you just articulated, Heath, history tells us that this bull market that we're in now, right, and this economic expansion, which hasn't officially been dated, we're going to get a look at Q3 GDP this week. We'll get our first look at Q3 GDP, and the National Bureau of Economic Research. Those are the folks who tell us when we go into recession and when we exit. And they said we were in recession beginning in February. And so it's most likely February, March, April, the economy bottoms, and then we move higher in May. And so we're in a new bull market and we're in a new economic expansion. And call me a silly optimist. The reason I want to believe history holds is because if we are in a new bull market and we are in a new economic expansion, and we are, even with this crazy pandemic that's wrapped around everything, this bull market and this economic expansion should both run for another 3 to 5 years. Right. So
I want to go. I think when I look at what history tells us, there's more good than bad there, and none of the signs that tend to be present at the end of an economic expansion. Obviously, it was a pandemic that caused it this time. Are present. So I want to lean heavy on history, even if that means some post-election volatility, because history tells us that by the time this bull market is over, it's going to be 2023, 2024, and believe it or not, the S&P will be up another 100 to 150%. So I'm going to go with that because there's enough upsetting news out there, and history tells us to be pretty optimistic right now.
Well, and I think we all realize that, there are factors outside of the market, COVID being 1A, that could change all this, right? But if
For sure.
It's a big thing to put to the side, but if you were to put it aside for a moment, the first month of the market after the election does not make the first year, right? And you kind of have to accept there's going to be some volatility inside of that. You've hit on it twice, actually. So I do want to touch on it and see if there's more there to unpack. So, kind of thinking about the split between Congress and the president.
Yeah.
And again, just working off the polls. So who knows where these go, but it seems likely that the Democrats are going to hold the House. Depending on who wins the presidency, we're talking 3 or 4 seats to take the Senate, right? And so does the market in any way need some form of gridlock, kind of given the uncertainty of things, or can it actually be a positive from the perspective that if we have to kind of dance in the first quarter of the year because things still are different with COVID, or we continue to be unusual times, maybe it makes it easier to get things done?
I think so. Not to be cynical, because I don't consider myself a cynical person, but so I think what the market's been waiting for, but it's been hanging in there independent of it, is the fourth COVID-19 economic rescue package, right? Speaker Pelosi and Secretary Mnuchin are still talking. The House under Speaker Pelosi passed the HEROES Act. I think way back in May, it was $3.2 trillion. Things didn't look so great then. Clearly, the economy's come a long ways back. The White House threw out $1.8 trillion, and they just can't seem to meet in the middle for all sorts of reasons. So I think the market would welcome another dollop of fiscal support, because I think the market's just worried about another wave in the winter and marginal shutdowns, and you're seeing some of that in Europe. So I think, if that starts to become a more likely than not under whatever political construct, I think the market would feel pretty good about that. And again, my personal opinion, I think if you went to the sort of Mr. or Mrs. stock market and said, all right, we're going to give you a couple trillion in additional fiscal spending, the bond market saying it's okay, but we're going to raise taxes on higher earning Americans and corporations, I think the market would take that in a heartbeat. I really think it would, because the fiscal spending is going to more than overwhelm the incremental taxes that some folks have to pay. The cynic in me says, okay, so say Donald Trump wins re-election, but maybe the Dems take the Senate, and they clearly, I think they are going to hold the House. I think you're right. So what if all of a sudden, Chuck Schumer says, I can wait this guy out for a couple of years. We're not spending any more money, even though clearly the Democrats want to spend money. Or say Joe Biden takes the presidency and all of a sudden Mitch McConnell, these budget deficits are out of control. I think we need to stop. And you kind of play this political brinkmanship around the midterm, and you're just trying to upend whoever sits in the White House and hurt that party. And if that means you kind of put the brakes on the recovery a little bit, so be it. I don't think as divided as we are on either scenario, that's the most likely outcome, because there's still too many people hurting. And until you get a vaccine or a treatment, there's still too many people that need help. And so, but the cynic in me says, okay, what if you have, Republican president, Democratic Senate, and all of a sudden, they're like, nah, we're not going to spend any more money, and we'll come after you in the midterms. And so I do worry about that a little bit, but I do think the market wants a little more spending, and the bond market is telling the government, go for it. You can continue to spend as much as you can. I think they should. I think it's, again, you kind of worry about how to pay for all this stuff a lot later, and just make sure you don't underspend and don't worry about overspending.
Right. Yeah. You're hitting on a common concern, I think, with our clients, that they try to kind of navigate two different views between what's going to happen in the near term after the election, call it the first year. And then as people start to think about the deficits and some of those potentially bigger long-term problems,
Yeah.
it's difficult to kind of make those two meet, I feel like. And so, oftentimes the response here is kind of the long term, we're overreacting to nothing here, right? You continue to do what you do and it's tethered to a plan and you don't make big changes. The short-term questions, if you have clients who are in some, they're just in the season of life where there's change and, they're approaching retirement. They have some other big factor. I can understand those questions about the short-term impact and trying to decide if you want to make some adjustments in the near term there. So I've always kind of felt like whenever we have these conversations about how things are so different, that typically they're not that different, right? Yeah. But there are some things this year that have been unique. And the first one I wanted to kind of get your opinion on was just the amount of mail-in ballots. And where that's relevant to me is that, we experienced Florida in 2000. Yeah. There's the opportunity here for a lot more. Yeah. And, markets like to know or think they know what's coming. They don't like uncertainty. For sure. So, I think this has been in some of Brinker's research, but is the concern there that as those come in, I think the number today was 63 or 64 million mail-in ballots. Yeah. Does that make things different this time around?
It could. And if I can share my screen, and I know Amanda's still on the webinar, if that functionality could be enabled, I'm not sure. I could always pull up a couple slides that speak to that, because to your point, we spent some time researching that. So you're right that the numbers are unprecedented, and we still have a week to go. And I think the good folks at the Pew Foundation, very credible organization, did a survey and of registered voters and asked them about voting preference into 2020. And 40% said they were going to vote by mail. And so to put that in context, since we've had mail-in balloting as an option, 16% of voters have voted via mail in any one election. That's the cap. So you're going to double that and then go up another 50%. And as you know, every state thinks about paper ballots differently. And there have been lots of court cases as to, can you extend the deadline and when must they be processed by? And here in the great Commonwealth of Pennsylvania, the Supreme Court said you have to extend the deadline for 3 days in terms of change the rules. So I'm going to try and pull up a couple. Bear with me. Let's see. Because we do have a couple slides on this, Heath, that I think are worth sharing. Okay, bear with me. So the folks in Wisconsin said, you can't, we're not going to let you do that at all. So what makes it tricky is, can you see, what if we can't call the election on 11/3? Great. Yep. Is that you don't have any uniformity around state by state processing procedures. So the first question is, a lot of folks still think we're going to know who won the election come November 3rd, or maybe within the first week, right? And so the folks at Axios, which is a political website, did their own survey, and about 75% of Americans thought, okay, within a week we're going to know, right? And maybe we will. And then to your point, we've got Florida. And so as investors, and we've been doing this for a long time, you look for patterns, you look for data points from history that help inform your thinking today. Well, outside of a contested election in the 1820s, the only other election that we have is Florida, right? George W. Bush versus Al Gore and the 2000 presidential race and the hanging Chad phenomenon. And so the markets, as you've already articulated, don't like uncertainty. So if you look at the chart of the S&P on the left-hand side of this slide, from the time of the election day to when the Supreme Court said, stop counting ballots and declare a winner already, the market was off over 4%. And 4% in 4 weeks, give or take, is a pretty meaningful pullback. Now, that said, we've been in this business for a long time. We also know that was the beginning of the deflating of the tech media telecom bubble of the late 90s. So we've taken that 4% pullback and put it in the context of that really tough bear market that began in really when the market peaked peaked in March of that year, well before the election. And back then you had egregious valuations, you had the Fed raising rates, you had the price of oil going up, and then 9/11 was coming, which obviously no one knew. And so if you think about the market today, the market's not going to like a contested election, right? The market hates uncertainty.
Yeah.
Rates are at zero, oil is low, valuation isn't all that stretched. So we don't have any of the conditions, that were present 20 years ago, into which that contested election kind of stepped, if that makes sense. And
Yep.
And the next two slides, social studies was my favorite class in high school. Mr. Romano, he's a great teacher. So my apologies for anyone on here who knows all this, but a quick social studies lesson, and I, truth be told, had to reacquaint myself with some of how this works. So you've got a surge in mail-in ballots because of the pandemic, and then that box on slide 18 just lays out when states begin processing ballots, and some when they come in, some before, there's no uniformity. So you've got an unprecedented surge in paper ballots, concern that the infrastructure can't handle it, which I think is a very reasonable concern. And then you've got processing policies that differ state by state.
Right.
And a lot of the states that don't start counting until election day or after the polls close are really important states like Michigan, right? And Pennsylvania. I put Pennsylvania, where I live, the Commonwealth, at the top of the battleground list. So this could be a real problem. We'll get through it, but we need to be prepared for it. And then finally, and this is kind of the hardcore social studies part of these slides, if we can't call the election on 11/3, hopefully we'll call it soon thereafter. But as we all know, the magic number you're trying to get to in the Electoral College is 270, right? Donald Trump lost the popular vote to Hillary Clinton by, I think, 3.5 million votes. Right. George W. Bush lost it to Al Gore by 500,000. Odds are, even if Donald Trump wins the Electoral College, he'll lose the popular vote again. So this map of the United States just lays out each state and how many Electoral College votes it gets. So you go from California all the way down to, call it, North Dakota. So just for the sake of argument, if you can't get to 270, and the thing that's both fascinating and frightening about that map is that there are 64 combinations that get you to a 269 to 269 tie, which is kind of scary. 64 sounds like way too many possibilities, but we may all know this. But again, just to square the circle on the social studies aspect here, if neither candidate gets to 270, it goes to the House for the presidential race, the Senate for the vice presidential race. And what's interesting is each state in the House gets one vote. So North Dakota gets one vote, California gets one vote, they pick the president. And as we all know, there are a lot more red states and blue states. And in the Senate, each senator gets a vote. So that's 100 votes, but again, more red than blue.
Right.
So even if there's a tie, even if we get to 269, which has never happened before, barring some unforeseen development, Donald Trump becomes president for another 4 years, and Mike Pence vice president. But I think you're right. I think the big concern is just the sheer amount of paper or mail-in ballots and the inability of the system to handle that. So
it's interesting. I was not as good of a student in social studies, so that was useful for me. So I appreciate that.
Yeah, hopefully, I hope that helped.
I had been thinking I would dive a little bit more into COVID, but I actually think we've kind of discussed that. So I want to focus a few minutes, if we can, on Brinker's probability grid, because I think that's a really useful tool. I've referred to it a lot. And so as I kind of think through, when you get the question from clients, what should I expect, right? Well, if I knew the answer, this would be very easy. Yeah. And so you kind of have to establish possible outcomes and identify the probability of each and kind of make plans around that if a client's looking to make some change. And,
for sure.
So for background, for people who wouldn't be familiar with this grid, what Brinker's basically doing is looking out over the course of the next, call it, 3 months. And, looking at the expected performance of the S&P 500 and just establishing what's the base case. What do we think is going to happen? But what are those outliers? What are the things that could occur? And I think those are the ones, frankly, clients are maybe most interested in. So like if you look at yours, and I'll be interested to hear if there's some change there, because I'm sure it's constantly moving, but Brinker's base case for some time has been kind of this sideways market. And movements no greater than 10% to the upside or downside. But then of course you have those scenarios that are outside of that. And those are the ones I think clients are really kind of asking about is, do we think there's a real potential for that big move up or maybe a retest of March? So I'd love to just get an update from you on kind of where Brinker's at now with that, and then maybe what changes, if any, have occurred over the last 30 days.
Yeah, so not much in the way of changes the last couple of weeks. In terms of a retest for March, you know, the market peaked on the 19th of February, sold off to March 23rd, and then began this dramatic and almost just, you know, nonstop ascent up and to the right. And then had a pretty rough September pulled back about 4.5%, has bounced a little bit here in October, even with the rough day yesterday. So we don't think, we think we've taken that retest off the table. Now, it doesn't mean you can't have a bear market, right, which would be a 20% pullback, but obviously to get back to the low 2000s where we were on March 23rd, you're going way beyond a bear market. You're looking at a 35 to 38% pullback. So we think the probabilities of a bear market are very low, call it 5%. And history to a certain extent tells you that, you know, once you enter a new bull market, the market does tend to move more often than not up and to the right. And we do think that the most likely outcome over the next couple of 3 months is a sideways market. But as you articulated earlier, Heath, we have increased our expectations around potential upside volatility and potential downside volatility. And the election's a big part of that, the uncertainty around the vote. Now, the politics of it all should have no long-term impact on the market and the economy, but it can be added to the volatility, the uncertainty, the angst it creates becomes a self-fulfilling kind of thing. And then if the election does lead to an uncertain outcome and a contested vote and a quite contentious sort of litigating of that, then that's going to weigh on sentiment and risk assets for sure. On the other side of the coin or the ledger is, and there hasn't been a lot of talk about this of late because one, there hasn't been much in the way of big news, and the news we've gotten has been more negative than not. Just somebody comes out and says, we've got a vaccine. Yeah. Right. I mean, so it's kind of it's a bit more binary near term, the uncertainty around the election and now the spike in the case count weighing on sentiment and risk assets. But the potentiality of a real breakthrough on the vaccination and or treatment front on the other side. The other thing, you know, again, you know, if you think about history, you know, we're about to come into, you know, the most seasonally strong part of the year for the market, right? You know, there are great adages in our business, sell in May and go away is one of them. May, June, July, August, September, October, you know, as you get into November, you get those votes counted. Hopefully it only takes a day or two. Historically, the market's done very well in November and December, an election year, well above average monthly returns. Then you're also in the seasonally strong period for the market. And again, I think the market's going to be, I think the market has its preferences in terms of the results of the election, but I think the biggest point of concern is a contested vote that just drags on and drags on. And if we don't have that, I think the market's going to find a way to live with whoever's driving the proverbial bus. So we do expect more volatility over the next couple of weeks. We've seen it in the last week or so. We wouldn't be shocked by it. We don't think there's almost no possibility in our minds that we're going into a bear market. And again, we've taken a retest scenario off the table, but we do think the next couple of weeks, next month or so could be pretty bumpy. But we still do think the trend is up and to the right, and the big catalyst will be getting those votes counted. And we're going to meet as an asset allocation committee early next week, so we'll be revisiting the market performance probabilities grid. But for the time being, you know, we still think again sideways, but you know, be prepared for some volatility the next month or so. Right.
Seems like everybody's prepared for the next few weeks, right? It's what comes after that and trying to see into the future.
And maybe we'll be pleasantly surprised, right? I mean, at a certain point, again, not to sound too Pollyannish, you know, we're going to be fine. The Republic's going to be fine. You know, we're going to get through this. And wouldn't it be nice if, you know, we're going to get some good news, and maybe it's around the election, maybe it's around COVID. I don't know, but we're due for some, and I think we're gonna get some. And I think everyone's kind of just on pins and needles, on the edge of their seat, whatever the analogy is, and they're waiting for the next shoe to drop. And you know, I think the next shoe is not going to drop. I think we're due for some pleasant news again, either around the vote or COVID, and I don't think anyone's expecting it right now.
Right. I'm with you. It doesn't feel like it's baked in anywhere.
No.
Certainly not in investor perception. It's easy. It's an emotional process. So no matter what side you happen to sit on, half the country's going to wake up the next day discouraged in some way. The market tends to get past it faster than a lot of us individually do, and the market does a good job of telling us what's coming, right? And so we get into the new year, and we'll start to glean insight from that.
For sure.
I could probably pepper you with about 50 more questions, but I think the intent today was try to keep it at 30 or 40 minutes. Is there anything though that you would like to insert into that I failed to ask you on? You feel like really kind of
I think we should all keep in mind or not forget what the Federal Reserve has done and continues to do. Right. The two big policy levers in this country, are fiscal and monetary. And the fiscal one, that lever's been put in place to support the economy a couple times now, but the market wants a little bit more on that front. We may not get it before the election. And the other big lever is monetary policy, what the Federal Reserve can do, and the Fed's all in, right? And Jay Powell's term is not up anytime soon. The Fed remains the world's most powerful central bank for the time being, at least, knock on wood. The dollar remains the world's most important currency. So even with all the give and take, the angst being created on the political side and the questions around fiscal policy, I think it behooves all of us to remember that the Fed's all in, and that's a big, big deal. And I think that's just gotten lost, understandably, just because of the news and the focus on the election. But I just, if you get really scared, remember at least, the Fed's there, and the Fed, I think, is just done an incredible job.
I'm with you. I think it's easy to focus on all the headwinds we face and kind of forget there's some pretty big tailwinds behind us that once the news cycle can turn a little bit, whether that be in a week or a few weeks, we can kind of turn our attention. Well, man, we covered a lot. Thank you. Thanks for making the time for doing this. It was a treat to get to talk through some of this with you.
Anytime.
Just appreciate you taking the time and doing this for us.
Yeah, no, it's great to see you. I hope you're all well. Stay safe. And hopefully we can circle back sometime soon. Yeah,
it'd be great. For all the members that are on, thank you all as well for giving us your time for this. Hopefully, inside of this that really there is no intent here to kind of drive anything from our view. It was to provide some information. I think a lot of that is useful. For those of you that are currently working with one of our advisors, if you have questions, I would direct you back to them. That's the best place to pick up this conversation. And for those of you that are members but are kind of looking for a sounding board for this, feel like you need somebody to talk through, we're not hard to find. You can access this via all our branches. Certainly find us through Community America's website, or if you want to get an email to wealthmanagement@cacu.com, we'll be sure to make sure that somebody gets in touch with you. So Tim, thank you. Everybody else who jumped on, appreciate your time as well. Hope everybody has a good rest of the afternoon.